If you were born before 1966, you have probably seen the warnings everywhere. Move your money before 2027. The tax cliff is coming. Your estate exemption is about to get cut in half. Act now or lose everything. Well, here's what most of those videos are not telling you. Congress already passed new legislation in July of 2025, and it completely rewrote the rules for 2027. The so-called tax cliff that everyone was panicking about, it is not happening the way you were told, but that does not mean you should do nothing. In fact, some of the old advice is now backwards, and following it could actually cost you money. Today, I'm going to clear up the confusion and walk you through 7 specific asset moves that actually make sense for retirees and near retirees right now. You will learn which old strategies to drop immediately, which new opportunities opened up because of the 2025 law changes, and the one stealth tax that is quietly eating away at more Social Security benefits every single year. For years, financial pundits warned that the Tax Cuts and Jobs Act was set to expire at the end of 2025. That would have meant higher income tax brackets, a smaller standard deduction, and the estate tax exemption dropping from nearly $14 million per person down to roughly half that amount. That created a genuine rush for people to gift assets, set up irrevocable trusts, and convert retirement accounts before the deadline. But in July 2025, Congress passed the One Big Beautiful Bill Act, and that law made most of the individual tax provisions permanent. Your tax brackets are staying at 10, 12, 22, 24, 32, 35, and 37%. The standard deduction is not shrinking. The federal estate and gift tax exemption did not drop. It actually rose to $15 million per person starting in 2026, $30 million for a married couple, and it is now permanent with inflation adjustments kicking in beginning in 2027. That means if you rushed to set up complex trusts or gave away assets you wish you had kept, you may have acted on advice that is now obsolete. While the federal estate tax cliff disappeared, a different tax trap is expanding in 2026 that could hit far more retirees than the old estate tax ever would. The alternative minimum tax, or AMT, is making a comeback. Under the new law, the AMT phase-out threshold drops to $500,000 for single filers and $1 million for married couples filing jointly in 2026. The phase-out rate also jumps from 25% to 50%. According to the Tax Policy Center, roughly 7.5 million taxpayers are expected to get snagged by the AMT when they file their 2026 returns in early 2027. That is up from just 200,000 a few years ago. So while your regular tax brackets may look friendly, this parallel tax system could quietly raise your bill if you are not careful about how you recognize income. That brings us to your first asset move, and it involves the cash sitting in your traditional IRA or 401k. If you are sitting on a sizable pre-tax retirement account, now is actually an excellent time to consider partial Roth conversions. Here is why. With the lower tax brackets now permanent, you have more clarity than ever about what rate you are paying today. You can convert a chunk of your traditional IRA to a Roth, pay the tax at a known favorable rate, and then let that money grow tax-free forever. The key word is partial. Too many retirees either convert everything at once and bump themselves into a higher bracket, or they avoid conversions altogether because they are afraid of the tax bill. A smart partial conversion keeps you in the 22 or 24% bracket, reduces your future required minimum distributions, and gives you a tax-free bucket to draw from later. Just remember, if you are already taking RMDs because you were born between 1951 and 1959, you must take your RMD first before doing any Roth conversion. That is a rule people overlook all the time. Now let us talk about the cash that is not in your retirement account at all. I am talking about the money languishing in a savings account, earning 1 or 2% while inflation is still running hot. If you have significant cash reserves, you need to ask yourself whether that money is working for you or against you. For retirees, cash is comfort, but too much cash is a slow leak in your financial boat. One option to consider is moving excess cash into Treasury bills, or I-bonds, where your principal is backed by the full faith and credit of the government, and your returns at least keep pace with inflation. Another option, if you have a longer time horizon, is to deploy some of that cash into a diversified taxable brokerage account with a focus on tax-efficient index funds. The mistake I see constantly is retirees keeping 5 or even 10 years of expenses in a savings account because they are terrified of market volatility. That fear is understandable, but inflation does not care about your feelings. It erodes your purchasing power whether you invest or not. Speaking of taxable brokerage accounts, concentrated stock positions, maybe you worked at a company for 30 years and accumulated a massive position in their stock. Maybe you inherited shares decades ago. Whatever the reason, having more than 10 or 15% of your net worth in a single stock is not a strategy. It is a gamble. And here is the surprising part. Because the capital gains tax structure has remained stable, now is a reasonable time to diversify those positions gradually. You can harvest gains in years where your other income is lower, spread the sales across multiple tax years, and even donate appreciated shares directly to charity through a donor-advised fund to avoid the capital gains tax entirely. The myth I hear constantly is that you should never sell a winning stock because the tax will kill you. If you have grandchildren, or if you funded a 529 plan years ago that your child never fully used, asset number 4 is going to surprise you. Starting in 2024, the Secure 2.0 Act allows you to roll unused 529 funds directly into a Roth IRA for the beneficiary. The lifetime limit is $35,000 per beneficiary. The account must have been open for at least 15 years, and the rollover amount counts toward the annual Roth IRA contribution limit, which is $7,500 in 2026, or $8,600 if the beneficiary is 50 or older. The beneficiary needs earned income at least equal to the rollover amount. There are no income limits on this rollover. So even if your grandchild is a high earner, who normally cannot contribute to a Roth IRA, they can receive this money. If you have a 529 plan sitting there with leftover funds, do not just withdraw it and pay penalties. Move it strategically into their Roth IRA over several years. That is a generational wealth transfer that actually compounds. Now, before we get to the next 3 moves, if you are finding this helpful, I would really appreciate it if you would hit that like button and subscribe. I do not sell insurance, I do not push annuities, and I do not work for Wall Street. I am just here to give you the straight facts so you can make better decisions with your money. Your support helps me keep reaching retirees who need honest information, not panic-driven sales pitches. Let us talk about asset number 5. And this one catches people off guard, because they think the federal estate tax changes solved all their estate planning problems. They did not. While the federal exemption jumped to $15 million per person, 12 states and the District of Columbia still impose their own estate or inheritance taxes. Washington state taxes estates starting at $3 million. Oregon starts at $1 million. Massachusetts has its own threshold. If you live in one of these states, or if you own real estate there, your estate could still face a significant tax bill, even if you are nowhere near the federal limit. That means moving assets into irrevocable trusts, making annual exclusion gifts, or even relocating to a no-estate tax state might still make perfect sense. Do not assume you are safe just because the federal exemption is high. State tax laws did not change when Congress passed the 2025 bill. Asset number 6 is something almost nobody is talking about, and it might be the most important review you do this year. If you set up an irrevocable life insurance trust, a spousal lifetime access trust, or any other advanced estate planning vehicle between 2020 and 2025, you need to look at it again immediately. Those structures were often designed specifically to lock in the higher estate tax exemption before the expected 2026 sunset. It is your Social Security benefit itself, not the benefit amount, but how you coordinate it with everything else. If you were born before 1966, you are either at or near your full retirement age, and the decision of when to claim is not just about the monthly check, it is about taxes. Here's a fact that should be on every retiree's wall. The income thresholds that determine how much of your Social Security gets taxed have not changed since 1983 and 1993. For single filers, if your combined income is between $25,000 and $34,000, up to 50% of your benefits can be taxed. Above $34,000, up to 85% is taxed. For married couples, the thresholds are $32,000 and $44,000. These numbers are frozen in time. They are not indexed for inflation. So as your other income rises, as RMDs kick in, as dividends and interest accumulate, more and more of your Social Security gets taxed every year without Congress lifting a finger. That is a stealth tax increase, and it is happening right now to millions of retirees who do not even realize it. Starting in 2027, the Secure 2.0 Act introduces something called the Savers Match. It replaces the old Savers credit with a direct federal matching contribution that gets deposited into your IRA or retirement plan. It is a 50% match on contributions up to $2,000 per person, but it comes with income limits and phase-outs. If you are still working part-time, or if you have earned income from consulting or a small business, this could be free money from the government starting in 2027. The details are still being finalized, but the key point is this. If you qualify, you want your retirement account set up correctly to receive that match. That means making sure your IRA is active, your contributions are documented, and you are not accidentally disqualified by having too much income in the wrong category. For retirees born before 1966 who are still working in some capacity, this is a small but genuine opportunity that most people have never heard of. The landscape for 2027 is not what you were told 2 years ago. The federal estate tax exemption is higher and permanent. Your income tax brackets are stable. The standard deduction is not shrinking. But new challenges have emerged. The AMT is expanding. State estate taxes are still lurking. Social Security benefit taxation is silently creeping upward because those thresholds never move. And opportunities like the 529 to Roth rollover and the upcoming Savers Match are sitting there waiting for people who actually know about them. So here is the single most important takeaway from this entire video. Do not make financial moves based on old headlines. The rules changed in 2025, and the strategies that made sense before that law passed may now be backwards, unnecessary, or even harmful. The best thing you can do today is pull out your estate plan, your tax return, and your account statements and ask one simple question. Was this set up for the old tax world or the new one? Schedule a review with a fee-only fiduciary financial advisor or a certified public accountant who understands the 2025 law changes. Not someone who wants to sell you an annuity, not someone who is still pushing 2024 urgency tactics, someone who will look at your actual situation and tell you which of these 7 moves apply to you, which do not, and what needs to change before you file your 2026 tax return in early 2027. You have worked too hard for too long to let outdated advice steer you wrong. Take an hour this week, make the call, and give yourself the peace of mind that comes from knowing your plan matches the world we actually live in. I will see you in the next one.